You should really, if you have one of these investment advisors, you should fire them. There's no reason in 2016 to have one of these people. You're thinking they're the only ones that could get you into really a very well diversified portfolio, but you're not realizing the truth. The truth is that there are thousands of ETFs out there which capture different market segments, and it's very easy to create your own portfolio, a well diversified portfolio, just by buying 5 or 6 ETFs. I'm going to give you 6 ETFs right now that you can invest in, and I'm going to tell you how to distribute your investments into them in order to adjust for your risk tolerance. So what are ETFs? ETFs are indexes that just hold stocks in many different companies, and you're basically betting on all of them at once. You're betting on aggregates. The first one you want to look at is the VOO. VOO is Vanguard's S&P 500 index fund. What's good about all these ETFs is that they're very low fee. You don't pay the kind of fees you pay to your investment advisor. The fees you pay to your investment advisor really eliminate the returns that you get, especially nowadays when there's no more 20% return in 2015 and 2016. You're getting, if you're lucky, 3-4% on your money, and that's going down the drain if you have one of these advisors. So the first thing you want to look at is VOO. VOO is, like I said, Vanguard's. Not Fortune 500, the S&P 500 large cap index. It has companies like Apple, Google, Exxon, and they hold a lot of different stocks. And if you're bullish on the idea of these big American companies doing well in the future, then invest some of your money into VOO. Also put some into VB. VB is small caps. What small caps are really American companies that are worth less, usually somewhere between $500 million and $2 billion. That's the riskiest investment really that you have, are these small caps, just because with these small size businesses, these businesses that are not oligarchies, and these businesses that aren't in bed with government, they could be wiped out in a day. They're very volatile, but of course you can really not eliminate, but you can mitigate a lot of the risk associated with those small caps by putting money into other ETFs as well. VWO is another great one. VWO is an emerging market ETF. They're invested in something like 17 different countries. You have all the countries like Brazil and China and the emerging markets. And it's very good to invest in emerging markets because emerging markets are risky, but the returns are very promising in a lot of places. When you look at China, they have 7 and 8% growth, and these, like VWO, is invested in a lot of China A shares. So they're buying the biggest companies. They're buying, these companies in China that are huge are backed by their communist government. So there's not too much of a chance that the government is going to just allow them to lose so much of their value in a market type of situation, in a free market. It doesn't happen. They're backed by the government. The government will take any step, especially in China. They'll kill whoever they have to in order to make sure that those companies are well protected. VNQ is a REIT. VNQ is the 4th ETF I want to tell you about. So VNQ is real estate, and historically real estate has great returns. These are some of the biggest real estate companies in America. If you always wanted to invest in real estate, but you don't have the cash to buy a property, and you don't want to take the risks associated with the property, like making the repairs and deadbeat tenants and things like that, then the best thing for you to do is to buy these REITs. They have great historical returns, and VNQ is one that has very low fees. It's something like the expense ratio is like 1/10 of 1%. It's 0.15, so it's very little, relatively speaking, and it's really something that you want to hold on to for the long term, because the real estate value and the returns on real estate are sometimes astronomical. especially with these big companies that acquire developments for so cheap and then just put money into building them and end up making a huge profit off them. So those four are really the risky ones. And in order to mitigate the risk associated with that, you want to put money in bonds as well. There's two bond ETFs that I recommend, because these bond ETFs are invested in bonds that have relatively short-term maturity rates. LQD is one that incorporates a bunch of corporate stock. So it's a little bit riskier than buying treasury bonds, but at the end of the day, it's still a lot safer than buying the stock in the companies, simply because, you know, you're going to get the return that's promised to you with most of these companies. And SHY is invested in 1 to 3 year short-term treasury bonds. Treasury bonds are backed by the U.S. government, and regardless of what you believe about the U.S. government is, you know, our central bank can print money like there's no tomorrow and lend it to the government. So our government has no issue paying these back. If you're aggressive in the market, you want a higher return, and you want to be exposed to more risk, you put more money in, you know, the large caps and in the emerging markets and real estate. If you want to be very conservative, put the majority, like 50-60% of your money, into the bonds that we spoke about, LQD and SHY. Put them in the corporate and the treasury bonds. Put 40% in treasury bonds and put 20% in, you know, LQD. That way you still will give yourself some exposure to large caps and small caps and emerging markets, but you can cut those down to like 10% each. This way your exposure is fairly limited, and it won't, if those markets take a hit, you could recoup some of that money with the investments you have in your bonds, especially because bond prices tend to go up dramatically when there's big crashes in stock markets. So that's really what I wanted to share with you. There's no reason for you to have one of these investment advisors. There's all these ETFs, and like I just told you, these 6 ETFs that I just told you about will have you so well diversified if you buy them that you the risk associated with it is very low in the long run. And I'm talking about 5, 10, 20 years. I'm not talking about, you know, these get-rich-quick schemes in the market, and these people that want their immediate return, or the ones that think that the market provides some kind of steady return. You can't look at the stock market or any market and look at what it's doing on a day-to-day basis if you're invested in the long term. If you're invested in the long term, what you want to do is diversify. How can you diversify? You can either buy a ton of different stocks, but that would basically mean you would have to pick the winners and losers, or you can buy these indexes which incorporate you know, the old S&P 500 and VOO, for example. So you're really betting on America when you bet on these indexes. You really are. You're betting on the fact that the country is you know, the markets are going to remain liquid, and they're going to remain solvent. And what you need to understand when you're investing is that over the long term, the markets always go up. The markets always go up because, you know, the central bank policy has a lot to do with the markets. As much as you think the stock market is based on the returns of the companies, they're not. The stock market is basically, it's all based on opinion. But what's guaranteed is that the returns in the market are going to be better than the returns you get anywhere else in the long term. I'm not talking, and I mean even through the crash if you hold and wait. The reason for that is primarily because of inflation. You know, the central bank prints money, consumer prices go up, and when consumer prices go up, these big corporations' revenues increase. What that ends up doing is increasing the price of their stock. So there's a direct correlation between, you know, the fact that our central bank keeps printing money and printing money and printing money, and what that ends up in turn doing is raising the prices of stocks in the long run, simply because the dollar is worth less, so their market share is worth more. In terms of dollars, of course. In terms of in terms of basic dollars, not in terms of real, inflation adjusted dollars. But we're not looking at inflation adjusted dollars over here. We're looking at basic. We're just looking at the quantity. What you should be doing is really investing in and the thing is, you don't need anymore any of these goddamn advisors. They don't do anything. We live in 2016. There are so many options for you. Even if you want to just invest a little bit, $20, $50, you can do it. There's services like Acorns and Betterment that are for people that don't want to invest a lot, but they give you the option to invest a little bit into these low fee kind of ETFs that at the end of the day you will make a profit off if you hold them. It's virtually guaranteed. I mean, there's nothing else that's more guaranteed in the country. Right now, interest rates are very low. Interest rates have been low for a long time. What that's done is scare people out of things like savings account and CDs and anywhere where your money is safe and insured. And the reason for that is they want you to invest in the market, mostly because by doing that, the central bank was able to get the market back up and recoup some of the losses, or all of the losses really, that all of these investment funds had, especially the bigger ones that were holding pensions and things like that. That was a disaster what happened in 2008 with that market crash, and it happens over and over again. And the only tool that we have to combat that is to lower the interest rates all the way down to zero, even negative, because that scares people out of accounts that are relatively safe and gets them to say the only way I can make a return is in the market. So over the long term, the market is really safe. The markets always go up, and that's because it's almost as guaranteed as it is that in 20 years from now, the prices of the goods that you buy, your rent, your food, your healthcare, your tuition, as guaranteed as that is to increase, that's how guaranteed it is that the market. So when you're betting on the markets in the long term, you're not really betting on the success of these companies. What you're betting on is the idea that prices are going to go up, and you need to get that through your head. Any investor in the long term needs to understand that you're betting on prices going up. That's what you're betting on when you're betting on the market. When you're betting on the real estate REITs, you're betting that prices in real estate are going to go up. When you're betting in emerging markets, you're betting that prices in emerging markets are going to go up. When you're betting on small caps, you're betting on the fact that small caps will go up. Well, those small caps are very, very dangerous. If you don't know what you're doing, you could lose everything in those small caps. Yes, the managed funds like Vanguards are relatively safer than you going out and picking winners and losers. But at the end of the day, you have to be in the large caps as well to capture the whole market as a whole. And you have to be in emerging markets. You have to be in real estate. And you certainly have to be in bonds. You should be anywhere from 20 to 60, 70% even in bonds, in these bond ETFs, if you really believe that you want to mitigate your risk and be more conservative. You could still have some exposure to the stock market, but the bonds are relatively safe compared to the stock market. So those are 6 ETFs: VOO, VB, VWO, VNQ, LQD, SHY. Those are stocks you want to be in. Those you can buy those with any brokerage. You can even leverage them. They're all very low fees. None of these have expense ratios of more than 0.2%. So you're going to yield a return on your investment over the long term regardless. There's no way. I mean, if it was the case where the markets would be down in the long term, that's really bad. You'd have bigger problems, let me put it that way. If you lost your money, if we're the situation where all of these things are down, real estate is down, emerging markets are down, our markets are down, and all these bonds are not paying out, governments are defaulting, we'd be in so much shit that you would have a lot bigger problems than the investment you had in the market. You would have trouble feeding yourself and things of that nature. Inflation in those cases would be so sky high that your returns would be, that the markets would not do anything for you anyway. So invest in these. Invest for your future, especially if you're young. If you're in your 20s, this is one of the smartest things you can do. Open up an account with somewhere like Acorns, put in $20 a month, and see what happens over the long term. It's a good way to save. You know, when you're putting your money in savings, if you are sure that you're not going to need that money for an emergency, this is not a rainy day fund type of thing. This is an investment. This is money that you know you're parting with and you will not get back for the next 10 to 20 years. You simply will not touch it. If you're willing to do that, open an account with Acorns or Betterment. There's a ton of other ones out there also. You could even open up you know, Acorns and Betterment are the type of services that will basically invest everything for you. They'll make the investment. You just tell them how exposed you want to be to the market, how much risk you want to take, whether you're more conservative or more aggressive. Of course, aggressive means better returns in the long run, but it also means more risk. So you just tell them that, and that's it. That's if you don't want to go out and buy these things yourself. But if you feel comfortable going into the market and putting in the orders, you can open up a leveraged account. You know, every brokerage is leveraged. The margin is about 25%, so you get 4 to 1 on your money. If you put in $1,000, you'll be able to invest $4,000. But in that case, you have to be careful, because when you're using leverage, you're exposing yourself to a lot more risk than you would in a cash account. Of course, because when you lose 4 times as much if you're investing 4 times as much. And 4 times as much of a loss can be tragic for you. A 5% loss would, in the short term, would be a 20% loss, and that might scare you out completely. So you need to use your brain a little bit when it comes to these things. It's a set it and forget it type of deal. You know, you want to set it, buy your positions, and forget it. I wrote an article about this. I read an article about this. It's down below. And if you click it, it gives you different portfolios, how much you should invest in each one of these 6 ETFs. And just go ahead and read it and see. It gives you a list of what each one of these ETFs is invested in as well. And you could look at the returns of them. It's very, very detailed. And it's a very good idea for you to consider it.